What I'm about to tell you is going to sound like a conspiracy theory, I get it, but stick with me for 5 minutes and you'll see why this is actually just mathematics, simple pattern recognition that anyone can verify. 4 weeks ago, on October 28, the American stock market hit one of the highest points in history. Investors were opening new accounts. People who hadn't looked at a stock portfolio in 5 years suddenly thought, you know what, maybe I should get in on this. That feeling you get when everyone around you seems to be winning, that's what was happening. Friends talking about their gains at dinner, your barber mentioning crypto, your mom asking about index funds, that kind of everywhere feeling. Here's the thing though, October 28 showed up in American financial history before, not once, multiple times, and every single time something happened. Not maybe something specific. October 28, 1999, Nasdaq at the absolute peak. Companies without a single dollar of profit trading for more money than General Motors, Microsoft, Intel, AOL, everyone's betting the farm on them. Newspapers running front page stories about day traders becoming millionaires. A guy quoted in Time magazine said, and I'm serious here, he said the stock market basically can't go down anymore because the economy had fundamentally changed. 3 months later, the Nasdaq started collapsing. It fell 76%, 76%. We're not talking about a correction here. We're talking about erasing most people's wealth in 18 months. Then October 28, 2007, exactly 8 years later. Different market, same date, the S&P 500 at 14,047. Housing boom in full effect. Everyone thought real estate always goes up. It's not like stocks, people said. It's different this time, they said. It's property. It's tangible. In 16 months, the market dropped 57%. Companies that had been around for over 100 years went bankrupt. Lehman Brothers just vanished. The financial system nearly collapsed. Now here's what gets me. October 28, 2025 just happened. Stock market near all-time highs again. Fed cutting interest rates. Media saying the worst is over. Consumer confidence at 6-month lows, but nobody seems to notice that part. Unemployment ticking up, but growth still happening. People confused but optimistic. And on October 28 specifically, that historical date, markets did exactly what they've done before. They peaked. You might be thinking, okay, that's interesting, but probably coincidence. I thought the same thing when I first spotted it, but here's what changed my mind. I started looking at what happened in between those peaks. What was the psychological state of markets? What did people believe? What were they doing with their money? And that's where it gets really relevant to your life right now, because I realized something. The crashes aren't random. They're not surprises that come from nowhere. They follow a pattern, a psychological pattern. And that pattern, the way people think before everything breaks, it's happening again, right now. And most people can't see it because they're too busy looking at the good headlines. Let me explain how this works, and I promise this is going to make sense because it's not about economics. It's about how human brains work. It's about fear and greed and the way groups of people think together. It's basic psychology dressed up in financial clothes. Think about this. Before a market crashes, there's always a specific sequence. It never changes. First, things are actually getting better, like genuinely better. Companies are making money. People are getting hired. The economy grows. This is real growth, real improvement, so everyone gets excited. Smart money, dumb money, retail investors, your friend who read one book about stocks, everyone's moving in the same direction, up. But here's where psychology enters the room. At some point, the growth is real, but not big enough to justify the prices anymore. The math stops working, but by then, people are already emotionally invested, they've already won money, they know people who've made fortunes. Your brain does something crazy in this situation. It basically shuts off the logical part. You know that quiet voice that says, hey, this might be too expensive? That voice goes silent, and it gets replaced with a different voice. The voice that says, what if I'm wrong about this? What if I miss out? Fear of missing out is more powerful than fear of losing. Scientifically, psychologically, it's been proven. Losing $10 hurts less than missing a $10 gain. So people borrow money. They take out loans. They use margin, which is a fancy word for borrowing from your brokerage to buy more stocks. They're not doing this because they analyze the fundamentals. They're doing this because they're afraid. They're afraid of being the one person at the party who didn't make money. And here's the thing that makes this boom phase so dangerous. Everyone borrowing money at the same time, everyone buying at the same time, it pushes prices higher. Higher prices attract more people who are afraid of missing out, so they borrow too, and prices go higher. It's a feedback loop. It's a perfect example of a bubble, and bubbles mathematically cannot expand forever. The math just doesn't work. But before the math breaks, something else happens. A few people, smart people or paranoid people or people who've seen it before, they look at the numbers, really look, not the surface level, not the headlines, the actual fundamentals, what companies are actually earning, what loans people are actually able to pay back, what the real economic growth is versus the growth that's just borrowed money being recycled. And these people sound alarms. They write reports, they go on TV, they say, this is unsustainable. And here's the crazy part. Nobody believes them. Not because they're wrong, they're usually right, but because admitting they're right means admitting you've been wrong. You've been making an emotional decision, not a logical one. Your brain protects itself. It rejects the warning. The news cycle moves on. The market keeps going up. This is the phase where I'm genuinely curious which group you're in. Are you someone who's listening to the warnings and dismissing them? Are you someone who hasn't heard the warnings? Are you someone who heard them and got out and missed the next surge? Or are you someone who heard them and stayed in anyway, hoping you get out before everyone else? These aren't judgmental questions. I'm asking because your answer also determines what happens to your money over the next 12 to 24 months. The historical record is clear. In 1999, people dismissed warnings for 3 months before the market turned. In 2007, people dismissed warnings for 18 months before the market turned. The warnings were accurate, the timing of when people would listen was not. Now let me tell you about the 3 specific things that happen every single time before a crash. Not every time the market is up, not every time there's a bull market, every single time right before a crash. And I want you to follow along because these 3 things are happening simultaneously right now, October 2025, all 3 at the same time. The first signal is what I call the credit bubble. When people start borrowing heavily to invest, that's not normal. That's a sign that they're no longer investing based on fundamentals. They're investing based on hope. In 2000, margin debt was growing 50% per year. In 2008, 40% per year. Right now, we're at 38.5% per year. That's not a slight uptick. That's 4 times the normal rate. That's people terrified of missing out. The second signal is valuation collapse. When rational multiples stop existing, when companies trade for 30, 50, 80 times their annual earnings, PE ratios. That's what we call them. The normal range is around 15 to 25. Right now we're at 30. Tech is way higher. Nvidia at 78 times earnings. That's not investment, that's organized hope. Organized hope always ends the same way. The third signal is the most important one. It's something called yield curve inversion. And this is where bonds and stocks start saying opposite things to each other. Bonds are the conservative money, long-term thinking investors, companies that are going to hold an investment for years. When bonds say the economy is going down while stocks say it's going up, that's when something's broken. That inversion has been happening consistently since early 2024. It's been waving a red flag for almost 2 years now. And guess what? Most people aren't even talking about it. All 3 signals are lit up right now. That never happens unless a significant market correction is coming. It doesn't mean tomorrow, it could be 6 months away. But historically, when all 3 light up at once, you've got a 12 to 36 month window before the real reckoning happens. Sometimes sooner, sometimes it takes longer, but it always happens. And here's what really gets to me. Here's why I'm making this video. Most people will hear this and dismiss it. They'll think, yeah, I've heard this before, doom and gloom from people on the internet, and they'll go back to whatever they were doing, and that's their choice. But some of you will realize, some of you will think about October 28. You'll think about how many times that date has shown up. You'll wonder if this time is actually different, or if it's just the same cycle playing out again in a different era with different company names and different headlines. The painful reality is this: the people who hear this warning and pay attention might miss some gains in the short term, but people who don't hear it or who dismiss it will lose everything they're not paying attention to when the reckoning comes. And then, and this is the brutal part, they'll sit out the recovery because they'll be scared. They'll have lost too much. They'll be the ones at social gatherings for the next decade saying, I used to invest, but the market screwed me. Never again. Meanwhile, people who stayed disciplined, who understood the cycle, who didn't panic on the way down or get greedy on the way up, those people will be compounding wealth through the entire cycle. That's how the real money gets made. Not in the up phase, in the up and down and up again phase, over and over, compound interest working on top of the cycle. This video is going to show you exactly what happened in 1929, what happened in 2000, what happened in 2008, the specific psychological phases, the specific indicators that flipped before everything broke. And then we're going to look at where we are right now, October 2025, and I'm going to show you evidence that we're in that same pre-crash psychology that happened before all the others. But here's what I won't do. I won't tell you to get out of the market. I won't tell you to sell everything and wait. That's not what the data says. That's not what history says. In fact, people who sold in 2006 and got out completely, they missed the biggest rally of their lifetime when the market eventually turned around. So I won't do that. What I will do is give you the psychological framework. I'll show you the specific numbers and signals to watch. I'll explain what phase we're in right now. And I'll give you options for what people with different risk tolerances have actually done in similar situations that worked. Not financial advice, just history, just patterns, just what the data shows, because knowing what phase you're in is the first step. And right now, I genuinely believe most people are in the phase where they don't want to know. They're winning, money's coming in, the headlines are good. Telling them they should be worried feels like I'm telling them their house is built on sand. Nobody wants to hear that when the house looks so nice right now. So let me flip it. What if I told you that knowing this pattern, understanding this cycle, puts you at an unfair advantage? What if the people who understand that crashes are normal, expected, part of the system are the ones who get rich? What if the people who panic are the ones who get poor? Because that's literally how it works. That's the actual historical record every single time. Let me walk you through what actually happened in 1929, because this is where the pattern starts revealing itself. This is the template that everything else copies. 1928, the economy was booming, seriously booming. Unemployment was low, wages were rising, people who'd lived through the hard times were seeing actual prosperity for the first time. Stock prices were rising, everyone could feel it. You could feel it in the streets. People had money to spend, construction everywhere, new industries starting up. This was real growth. This wasn't manufactured, this wasn't built on fairy tales. The economy actually was improving. And then something shifted. The growth was there, but the prices kept climbing faster than the growth could justify. Companies that made sense at certain prices suddenly didn't make sense anymore. But here's the thing, by that point, people were already a emotionally attached to the outcome. They'd already made money. They'd already beaten their friends. They'd already told their family members what to buy. You can't just walk away from that. Your pride doesn't let you. In November of 1928, an economist named Roger Babson, actually quite respected at the time, he stood up and made a public statement. He said there was going to be a huge crash. He gave specific reasoning. He showed the fundamentals. He walked through the numbers. And you know what the newspapers called him? A panic monger, an alarmist. They ran headlines basically saying this guy was crazy. The stock market, in response to his warning, went higher, not lower, higher. Because if there was really going to be a crash, the thinking went, wouldn't the market have already fallen? If smart people thought danger was coming, wouldn't prices already be down? That's the psychology right there. That's the exact moment I need you to understand. People don't reject warnings because the warnings are wrong. People reject warnings because accepting them means admitting something uncomfortable, admitting you were wrong, admitting you were driven by emotion instead of logic. The human brain will bend itself into ridiculous shapes to avoid that admission. 2 months later, the market turned. October 1929, not gradually, violently, 89% decline. Take that in for a second. If you had $100,000, it becomes $11,000. Your retirement disappears, your savings disappear, your future disappears. And the recovery? 25 years, an entire generation waiting to get back to even. But here's what really matters for today. The people who went through 1929, they never came back to the market. Not for decades. The emotional scar was too deep. There were fortunes made in the recovery, but not by them. They checked out. They decided markets were rigged and dangerous and they weren't gonna play anymore. So they held cash. They watched from the sidelines. They were safe, but they were also poor relative to people who stayed disciplined. Now jump to 2000. Different world. Internet boom. This is where the story gets darker in a particular way because this is where psychology becomes rationalization. Companies with no revenue were trading at valuations higher than General Motors. General Motors, which had factories and workers and decades of business relationships and actual cash flowing in. But these internet companies, they had an idea. They had a website. Sometimes they didn't even have that. Sometimes they just had a business plan and they were worth billions. Billions. I need you to sit with that for a moment. No product, no revenue, no path to profitability, but billions in market value. The logic people used to justify this was something like, the internet changed everything. Traditional metrics don't apply anymore. This time is different. You hear that phrase a lot in bubble phases. This time is different. Usually what that means is, I know this doesn't make sense, but I'm making money, so please don't make me think about it. And here's where the psychology gets interesting. A Nasdaq stock at that time in 1999, PE ratio around 100. Some companies trading at multiples that were literally meaningless because they had no earnings. 0 divided by something is undefined. The risk was obvious, not hidden. Obvious, you could do the math yourself, but remember what I said about the brain shutting off? Here's what people actually did. Some of them, the ones who'd been burned by other crashes or recessions, they pulled out early. They got out in 1998. They called the top. They got out with profits, and then they watched for 3 years. They watched the market go up another 40, 50, 60%, and they thought, maybe I was wrong. Maybe I should get back in. Some of them did. Those people got completely crushed. The really painful part was the rationalization that happened in their own minds. When people got out early, they didn't think, I was right to be cautious. They thought, I was too scared. I'm not tough enough for investing. They adopted the belief that being in the market was brave and getting out was cowardly, so they got back in. And then everything collapsed. The rationalization during the bubble was even worse. People told themselves stories. They said, sure, this company doesn't have revenue, but look at the user growth. Look at how many people are visiting the website. Eventually, they'll monetize it. Eventually. That word did a lot of work in the late 90s. Eventually became the most important word in investing. Eventually, this company would make money. Eventually, the losses would turn to profits. Eventually, the math would work out. Eventually arrived in the year 2000. The collapse. Nasdaq from 5,048 down to about 1,200. That's a 76% decline. I want you to imagine that. If you had invested $100,000 at the peak, by the bottom you'd have about $24,000. Most of your money gone. And here's the thing that gets me. The recovery? 15 years. 15 years to get back to those previous highs. That's a full generation of no progress. But the psychological part is where it's really brutal. When the Nasdaq was going down, people held on. They thought it was a temporary dip. They thought, I'll wait for the recovery. Except the recovery didn't come for 15 years. So people sat there in stocks that had lost 75, 80, 90% of their value, watching, waiting, hoping, gradually coming to the realization that this wasn't temporary. This was their new reality. When people finally did come back to the market, most of them did it wrong. They'd been traumatized. They'd been in pain for so long. When the market finally started recovering, some of them got back in, but they were scarred. They bought cautiously. They tried to time the bottom and missed it. They were never aggressive enough. They never committed fully. So even though they were back in the market during the recovery, they didn't make the money they could have made if they'd either gotten out completely when the crash was happening, or if they'd never tried to be cute and just stayed invested the whole time. That's the real cost of the crash for most people. It's not the money they lost, it's the permanent alteration to their relationship with risk, it's the 15-year opportunity cost, it's the decision making that got worse because they were emotionally scarred. Now let's talk about 2008, because this one is important for what's happening right now. This is the the one that rhymes with today, 2006, the housing market was on fire. People were buying houses not because they needed a place to live, but because they knew they could flip it for a profit. Construction workers were making six-figure incomes. Plumbers were becoming real estate investors. The basic assumption was that house prices couldn't go down. Not meaningfully, not for long. These are houses. They're physical. They're necessary. Everyone needs a place to live, so prices would keep going up. But the math was already broken. People were taking out loans they couldn't afford. Variable rate mortgages where the initial payments were low, but then they'd spike. Option arm loans where people could pay less than the interest due each month, so their principal balance actually increased while they were paying. Subprime borrowers, people with bad credit, were borrowing more than the house was worth. The entire structure was held together by the assumption that house prices would keep rising. The second that assumption broke, everything broke. In August of 2006, people who were paying attention started sending warnings. JP Morgan made statements about the housing market being vulnerable. The Federal Reserve started noting stress in certain segments. There were legitimate, credentialed voices saying, "This is not sustainable. This could cause serious economic damage." The response? The mainstream media was skeptical. Other analysts said, the housing market is fundamental to the economy. It can't collapse the way the stock market did in 2000. This time is different, that phrase again. The housing market is different. It's backed by physical assets. It's different. And here's the part where the psychology gets really dark. People who heard these warnings and took them seriously, they got out of housing stocks. They reduced their exposure. They got to safety. And then the market kept going up for 2 more years. From 2006 to 2008, there was still money being made, deals still being done, construction still happening, and the people who'd gotten cautious, they watched this and thought, I was wrong again. I'm always the scared one. Everyone else is making money and I'm sitting on the sidelines. Some of them got back in. Some of them never got back in, but they regretted it. By 2008, the market finally broke. The S&P 500, from its peak of 1565 in October 2007, it crashed to 666 in March 2009. That's a 57% decline. Lehman Brothers, one of the biggest investment banks in the world, ceased to exist. It just vanished. But here's what I want you to focus on. The warning signs came 2 years before the crash. 2 years. People heard them. Smart people, credentialed people, people whose entire job was to understand financial markets, and most people ignored it, not because the warnings were wrong, but because they were inconvenient. They contradicted the feeling of opportunity. The people who listened to the warnings in 2006 and got out early, they missed the gains in 2007. They thought they were wrong. Some of them got back in late 2007. Those people got crushed. The market fell 57% in about 16 months. Your $100,000 becomes $43,000. But then something happened that almost nobody talks about. From 2009 to 2020, there was the biggest bull market in modern history. The S&P 500 went from 666 to over 4,000. That's a 500% gain. 500%. Multiply your money by 6. That's what happened for the next 11-12 years. The people who sold in the panic in 2008 or 2009 and swore they'd never invest again, those people missed 500% gains. That $100,000 that became $43,000 if they'd stayed invested would have become $300,000. More than triple their original amount, but most didn't. Most people who got scared once stayed scared. They kept the money in cash, they kept it in low-yield savings accounts, they kept it in bonds that returned 2 or 3% per year, while the market was returning 20% per year. That's the real cost of panic. It's not losing money once, it's missing the recovery. It's being emotionally damaged in a way that prevents you from winning when winning is available. The psychological pattern across all 3 of these crashes is identical. Warning phase, where smart people know something is wrong, but almost nobody listens. Continuation phase, where the market goes up for months or years longer than any reasonable person would have predicted. Crash phase, where reality asserts itself violently. Recovery phase, where the people who've been traumatized sit out on the sidelines while fortunes are made. Each cycle is a $1 trillion transfer of wealth from people who panic to people who understand cycles. Now, let's look at what's happening right now. October 2025, we're going to walk through the specific economic indicators that preceded the previous crashes, and we're going to see where they are right now. Not to frighten you, to inform you, to give you the data so you can make your own decision. First, unemployment. This is straightforward. In June 2025, unemployment was at 4.1%. By August, it was 4.2. By September, 4.3. Chicago Fed is estimating October at 4.35. That's 3 months in a row of increasing unemployment. Nothing dramatic yet, nothing that's going to make headlines, but it's a trend, it's consistent, and it matches what we saw in 2006. Before 2008, unemployment didn't spike overnight. It gradually ticked up. 1 month 4%, next month 4.1, next month 4.2. By the time people were aware it was rising, the recession was already in progress. Consumer confidence, Conference Board Consumer Confidence Index came in this month at 104.7. That sounds fine until you realize it was 105.3 last month and 108 last month before that. It's been declining for months, and more importantly, the questions about job availability are at alarming levels. People are worried about finding work. That doesn't show up immediately in hiring data. That shows up in behavior. People stop spending, they pull back, they save instead of consume, and consumer spending is about 70% of the US economy. Federal Reserve policy, the Fed cut rates by 0.25% 3 weeks ago. This is important because the Fed doesn't cut rates when things are going well. The Fed cuts rates when it's trying to stimulate a slowing economy. Powell basically said in the press conference that this might be the last cut of 2025, so they're acknowledging economic weakness. They're not saying it publicly in scary terms, but they're cutting rates. You don't cut rates when everything is fine. Government debt, this is where it gets really interesting. US government debt is now at about 122% of GDP. That means the government owes money equal to 122% of everything the country produces in a year. The government is borrowing about $2 trillion per year right now. Why? Deficits, spending more than we bring in, consistently. That's not temporary, that's structural. And the government is basically the lender of last resort. When the government is stressed, when the government is borrowing this heavily, it usually means private lending is weak. Companies aren't investing, people aren't borrowing. The government has to fill the gap. Corporate debt levels. Companies have been paying down debt over the last 18 months. That sounds good on the surface, but here's what it actually means. Companies are using cash to pay down debt instead of investing in growth, instead of hiring people, instead of buying equipment. They're being defensive. They're building cash reserves. You know when companies do that? When they're worried, when they see something coming. And here's the most telling indicator. Margin debt. The Federal Reserve data shows margin debt in the United States at $1,130 billion. That's a record, literally the highest ever. But here's what's really interesting. Margin debt is growing at 38.5% annually, while profit growth is around 5 to 10%. That gap is unsustainable. You can't have debt growing at 38% and earnings growing at 8% indefinitely. The math breaks down. In 2000, margin debt was the clear warning sign. In 2008, margin debt was elevated and growing. Right now, we're at the highest margin debt has ever been, and it's growing at a rate that's nearly impossible to sustain. So we have unemployment rising, consumer confidence falling, the Fed cutting rates, government debt at record levels, corporate debt being paid down, and margin debt at record levels, while profit growth stalls. These aren't subtle signals. These are all indicators that something is off. Now here's the thing, this doesn't mean the crash is tomorrow. The market could go up another 20% before anything bad happens. That's what happened in 2006. Warnings came out and the market went up for another 18 months. That's the infuriating part of all this. You can be right about the overall direction and still be wrong about the timeline. But what I can tell you is we are in the warning phase. We are in the phase where credible people are starting to say something is wrong. We're in the phase where the economic indicators are starting to flash warning signs. We're not yet in the panic phase. We're not yet in the crash phase. But the configuration of indicators, this particular combination, it doesn't show up in healthy bull markets. It shows up right before recessions and significant corrections. So here we are, October 2025. We have all the warning signs firing at once. Unemployment rising, consumer confidence falling, margin debt at all-time highs, government and corporate debt in precarious positions, the Fed cutting rates to stimulate an economy that's supposed to be strong. None of this makes sense unless you understand the cycle. But here's where it gets personal. Here's where this actually matters to your life right now. The psychological phase we're in right now is called denial. Not panic, not yet. Denial. It's characterized by contradictions that people avoid looking at directly. People see good headlines, so they think everything is fine. They ignore the unemployment ticking up. They ignore the corporate layoffs that keep happening but aren't front-page news. They ignore consumer confidence falling because the headlines are good, because the market is at records, because their brokerage account shows green numbers. This is the exact psychological state that existed in mid-2007. Markets hitting records, unemployment low, companies still hiring at the surface level. But underneath, there was stress, there was weakening, there was structural strain that wasn't visible until it was too late. Here's what I'm about to tell you is going to sound contradictory. That's intentional, because the situation right now is contradictory, the data is contradictory, and how you handle that contradiction will determine whether you win or lose over the next few years. People ask me all the time, should I get out of the market? And my answer is always the same. No, not if you're trying to time it, not if you're planning to sit in cash and wait for the crash and then jump back in. That strategy sounds good in theory. In practice, it's how people lose the most money. Think about what happened to market timers in 2006. They got out, the market went up for another 2 years. They looked ridiculous, they felt stupid. So when the crash finally came in 2008, some of them got back in because they didn't want to miss the recovery. Except the recovery came 11 years later. They got in near the bottom, but they were scarred. They were cautious, they didn't commit, they missed the real profits. So getting completely out is a trap, but being 100% in at these valuations is also a trap. What you want to do is position yourself for both outcomes. You want to be structured in a way where a crash doesn't destroy you and a continued rally doesn't leave you out. Here's what that actually looks like. Let's say you have $100,000. Instead of being 100% in stocks, you might be 70% in diversified equity exposure, index funds, broad holdings, not individual stocks, not trendy sectors, broad market exposure. Then you might be 20% in fixed income or bonds, something stable that goes up when stocks go down. Then you keep 10% in cash or cash equivalents, money market, short short-term bonds, things that give you liquidity. Why that structure? Because if the market continues up, you're still up 70%. You're not going to outpace someone who's fully invested, but you're going to make good money. And if the market crashes 30 or 40%, your 70% stock portion crashes 30 or 40%. That's bad, but your 20% in bonds probably went up 20 or 30%. Bonds go up when stocks go down. That's exactly what happened in 2008. The 20% bond position would have offset some of the damage, and that 10% cash position, now it's very valuable. Now it's your ammunition. Because here's the thing about crashes that nobody talks about. Crashes aren't bad for people with cash. Crashes are good for people with cash. When stocks are down 50%, when the market is terrifying, when headlines are apocalyptic, people with cash can buy assets at 50 cents on the dollar prices. That's how fortunes are made, not in the bull market, in the crash, for people who have cash when the crash happens. That 70-20-10 structure is sometimes called a balanced portfolio. It's boring, it's not sexy. In a bull market, you'll underperform. People will make fun of you. Your more aggressive friends will be up 40% while you're up 20%. But in the crash, you'll cry less. And after the crash, when you have that 10% ammunition, you can buy assets at discount prices and you'll compound faster than the people who were completely wiped out and took years to get back to even. But here's where the psychology gets really interesting, and this is the part that matters. The reason most people don't do this, the reason most people stay 100% invested in a bubble or 100% in cash in a crash is psychology. It's emotion, it's fear, it's the inability to be boring when everyone around you is being exciting. Right now, if you go to a balanced portfolio, if you move to 70-20-10, your friends who are in technology stocks are going to be up more than you. They're going to show you their gains. They're going to ask why you're not taking more risk. That pressure is real. The social pressure to do what everyone else is doing, that's powerful. It's one of the strongest forces in markets. It's why bubbles happen. It's why crashes are so painful. Everyone's doing the same thing, and if you're different, you feel wrong. But here's what happened to people who resisted that pressure in the past. In 1999, the people who had a balanced portfolio while everyone else was in technology stocks, they felt stupid. They looked like they didn't understand the new economy. They looked cautious, scared, unsophisticated. Those people underperformed in 1999. In the year 2000, they crushed it. They had money while everyone else was panicking. The money they had was worth more than the money everyone else had because they could buy assets at better prices. Same thing in 2007. People with balanced portfolios looked like they didn't understand real estate or finance. They looked conservative. Maybe they were underperforming. Then 2008 happened. They survived. People who were fully invested didn't. Some of them lost everything. Now, I want to address something head on. You might be thinking, okay, but what if the market keeps going up? What if we don't have a crash and I've been in a boring balanced portfolio and I've missed the gains? That's a fair question. And the honest answer is yes, you will have missed some gains. That's the trade-off. But here's the historical reality. Since 1954, when we have good data on this, the US stock market has crashed 30% or more 9 times. 9 times in 70 years. That's every 8 years on average. You might get lucky and not hit a crash for 15 years. That happened in the 80s and 90s. But historically, you're going to hit one every 8 to 10 years. And when you do, having a balanced portfolio, instead of being fully exposed, is the difference between sleeping at night and waking up in a cold sweat. The really sophisticated investors, the people who've made serious money over multiple decades, they don't try to maximize gains in bull markets. They try to minimize losses in bear markets. They know that the money is in the survivor's advantage. The person who doesn't blow up in the crash, who still has capital to deploy, who stays disciplined while everyone panics, that person ends up with more compounded wealth over time than the person who squeezed out an extra 5% in the bull market but got decimated in the crash. Now, there's another psychological thing I need to talk about, and this is where it gets really dark. When crashes happen, when the market falls and keeps falling, there's a specific phase that investors go through. It's called capitulation. It's when everyone finally admits it's bad. It's when the last person who was holding out in hope finally sells. That moment is usually the bottom. That moment is when the most money is being lost. But that moment is also when you want to be buying if you have cash. In March 2009, the S&P 500 was at 666. Absolutely terrifying. People were losing their minds. Unemployment was spiking. The news was apocalyptic. That was the bottom. If you bought at 666, you would have made 500% gains over the next 11 years. But here's what most people did. They sold near the bottom. They took their losses, they got to safety, they didn't buy, and then they regretted it for the next decade. The people who bought in 2009, they had to be mentally strong. They had to look at news headlines saying the world is ending, and they had to think, this is actually the moment to buy. That's not natural. That goes against every instinct. That's why it's so profitable. Most people can't do it. So here's what I'm going to suggest, and this is practical, this is actionable. You might already be doing this, in which case, good for you. You're ahead of the game. First, examine your portfolio right now. If you're younger, under 40, you can probably handle more stock exposure. But even then, consider having some ballast, some bonds, some stability. Not because you're scared of the market crashing, but because downturns are normal and you want to be structured for normal market cycles. If you're closer to retirement, if you're over 55, a 60-40 portfolio, or even even 50-50 is not crazy. It's not conservative, it's appropriate. It means you get stock market upside, but you have significant protection. During the 2008 crash, a 60-40 portfolio went down about 30%. A 100% stock portfolio went down 57%. That's not a small difference when you're in year one of retirement and you need that money to live on. Second, if you have cash, don't feel stupid about it. In 2007 and the first half of 2008, holding cash looked like a terrible idea. Everyone was making fun of Berkshire Hathaway because they were holding cash. Buffett was mocked for not investing. Then the crash happened and that cash became incredibly valuable. There's wisdom in holding dry powder. Third, stop listening to people who are trying to get you to use leverage. Stop listening to people who are telling you to go all in. Stop listening to people who are making fun of you for being cautious. The loudest voices in a bull market are usually the ones who get wiped out in the bear market. They're not wrong necessarily, but they're incentivized to encourage risk-taking. That's how they make money, not by your long-term success, but by your activity, by your buying and selling, by your leverage. Fourth, educate yourself on what cycles look like, not to predict them. Nobody can predict them accurately, but to recognize the phases when you're in them. When you see unemployment ticking up and consumer confidence falling while stocks are at records, you should recognize that as a warning phase. Not a panic phase, but a warning phase. You should be positioning accordingly. And fifth, this is important, don't panic when the crash comes. Don't treat it like it's the end of the world. Crashes are regular, they're normal. They happen approximately every 8 to 10 years. They're brutal when they happen. People lose money, people lose jobs. It's painful, but it's also an opportunity. And if you're positioned properly, if you have a balanced portfolio and you have some cash, when the crash comes, you'll look at it as an opportunity instead of a catastrophe. Here's what that looks like psychologically. Most people in a crash feel fear. Real fear. Their account is down 30%, 40, 50%. They see headlines about economic collapse. They feel like they made a terrible mistake. The emotional response is to get to safety, to sell, to get out. The pain is immediate and real, but people who are positioned properly, who have a balanced portfolio that's down 20% instead of 50, who have 10% of their portfolio in cash, they feel something different. They feel opportunity, they think about which assets are now available at discount prices. They're not focused on the pain of the decline, they're focused on the opportunity that the decline creates. That's a completely different emotional experience, and it leads to completely different financial outcomes. This is why understanding the cycle is so valuable. This is why knowing that crashes happen every 8 to 10 years is valuable. When the crash comes, instead of being shocked and scared, you can think, okay, this is cycle number whatever. I've been expecting this. I'm positioned for this. Now I get to deploy cash at discount prices and compound returns faster than people who capitulated. That shift in mindset, that's where the money is. Now let me bring this back to where we started. October 28, that date that keeps showing up, 1999, 2007, 2025, all peaks, all on the same date. Is that coincidence? Maybe, probably, statistically speaking. But it's a good reminder that patterns do repeat, cycles do happen, and the more patterns you recognize, the better positioned you are to handle them. What I'm not gonna tell you is that the crash is coming next month or next quarter. I don't know. Nobody knows. It could be 6 months away, it could be 18 months away. Market crashes are predictable in direction over the very long term. The direction is down every 8 to 10 years on average, but the timing is impossible to predict. That's the infuriating part. You can know a crash is coming and still be wrong about when. You can be early and look stupid for years. But what I will tell you is that the combination of signals we're seeing right now is consistent with pre-crash environments, not consistently with healthy bull markets, with warning phases that have historically preceded corrections and recessions. So the prudent thing to do is to position accordingly, not with fear, not with panic, with discipline, with structure. Here's the bottom line. If the market goes up another 30%, a balanced portfolio will go up 20%. You'll be fine. Your friends who are fully invested will feel smarter than you for a while, but you'll still make good money. If the market crashes 30 or 40%, a balanced portfolio will go down maybe 20%. Your friends who are fully invested will be down 30 or 40. You'll feel smarter than them. And more importantly, you'll still have capital. You'll have dry powder. You'll have the ability to deploy cash when assets are cheap. Either way, you win. The structure I'm describing, the balance, is not designed to get rich quick. It's designed to not lose. And for most people, not losing is the hard part. Getting rich is what happens when you don't lose over many years. Compound interest does the work. You just have to not blow yourself up. I'm going to be direct about something. If you're watching this and you're a young person, 20 to 35, and you're fully in stocks right now, I'm not going to tell you to move to a balanced portfolio. You have time, you can weather crashes, you have decades to recover. But I am going to tell you this. Understand that you're taking on crash risk. Understand that there will be years where you're down 40%, and that's normal. And you just have to live with it. Don't panic and sell in year one of the downturn and then miss the recovery. Because that's how young people lose the most money. They panic too early. They haven't lived through enough cycles to know that downturns are normal. If you're 35 to 55, which is probably the largest audience sense for this content. I think a balanced portfolio makes sense. 70-30, 60-40, something in that range. You have enough time to recover from crashes, but not so much time that you can be completely casual about them. And you probably have some life goals coming up, sending kids to college, paying for a house. Those things have timelines. You don't want to crash 2 years before your goal date. That destroys your plans. If you're over 55 and you're working toward retirement, you should probably be more conservative than you are. Most financial advisors recommend a 40 to 50% stock allocation when you're in the 5 to 10 years before retirement. Not 100% stocks. You need some stability. You need some predictability. You need to know that even in a bad market year, you've got income, you've got cash flow from your bonds. After retirement, you probably want something like a 40 to 60% stock to bond mix depending on your needs. Yes, stocks can crash, but you need the long-term growth to fight inflation. You can't just be in bonds for 40 years of retirement. The purchasing power will destroy you. You need some equity exposure, but you also need enough stability that you're not worried every time there's a down market. This is not sexy advice. This is not going to make you rich quick, but it's the advice that's going to make you not poor slow. And that's the foundation of everything else. Now, here's what I want you to think about for the next few weeks. Watch the unemployment rate, watch consumer confidence, watch what the Fed does. These things are public information. The unemployment rate comes out the first Friday of every month. Consumer confidence comes out later in the month. Fed meetings are scheduled. You can pay attention to these things. You can track them. You can recognize the phases yourself. If unemployment keeps ticking up and consumer confidence keeps falling, that's a confirmation that we're in a warning phase. If at the same time the market keeps going up, that's creating a bigger divergence. That's creating more stress in the system. That's the kind of thing that historically precedes significant corrections. I'm not telling you to make major changes immediately. I'm telling you to pay attention, to be aware, to recognize the phase you're in, because recognition is the first step toward appropriate action. And here's the thing that most people miss. You don't have to be right about when the crash comes to make money from understanding this cycle. You don't have to call the exact bottom. You don't have to sell at the top and buy at the bottom. If you're just structured to be defensive before the crash and aggressive after the crash, if you're just disciplined about that, you'll outperform 95% of other investors. That's it. Just be defensive before crashes and aggressive after. Most people do the opposite. They get aggressive before crashes because everyone else is doing it, and they get defensive after crashes because everyone is panicking. That's how they lose money. The investors who beat the market aren't usually smarter than everyone else. They're just disciplined about doing the unpopular thing at the right time. They buy when everyone is selling. They sell when everyone is buying. They don't need to be right about the precise timing. They just need to be contrarian at inflection points. That's available to you. You can do that. It doesn't take genius level intellect. It takes discipline. It takes emotional control. It takes accepting that you're going to look wrong sometimes. You're going to be cautious while the market is soaring. People are going to mock you. That's the price of the edge. The market is going to crash and people who were fully invested are going to blame themselves. You're going to be calm because you expected it, because you positioned for it. That calm, that psychological equilibrium in the chaos, that's what creates the edge. That's what lets you deploy capital when everyone is panicking. That's what lets you compound wealth when other people are in pain. So back to October 28, I promised I'd bring it back around. That date that keeps showing up, that historical pattern. What does it mean for you? It means you should be paying attention. It means you should understand that we are currently in a phase that has historically preceded market corrections. It means you should position defensively, not with fear, with discipline. It means that the next time someone asks you, why aren't you all in on stocks? Why are you in bonds? Why are you holding cash? You can explain to them that you understand cycles, that you understand crashes happen, that you're positioned to survive them and profit from them, and that while they're going to make more money than you in the bull market, you're going to lose less in the bear market and deploy more capital in the recovery. And over a full cycle is what matters. You'll have more compounded wealth. It means you should be ready for continued upside if that's what happens, ready for a correction if that's what happens, ready to stay disciplined either way, ready to be boring while everyone else is excited, ready to be active while everyone else is terrified, ready to be the person who understands the pattern instead of the person who's caught off guard by it. And here's what I'll tell you. Years from now, if I'm right about this and a significant crash happens in the next 12 to 36 months, you're going to think back to this video. You're going to remember October 28. You're going to remember the warning signals. You're going to remember that you could have positioned better. And either you'll be glad you did or you'll be disappointed that you didn't. That outcome is up to you. But if you watched this and you actually took it seriously, if you actually positioned yourself for both scenarios, if you actually built that balanced portfolio with some dry powder, then when the crash comes, and it will come eventually, you're going to be one of the people deploying capital. You're going to be one of the people making life-changing money in the recovery. You're going to be the person who looks back and says, yeah, I understood the cycle, I positioned for it, and I built real wealth. That's the outcome I'm hoping for you. Not that the crash happens immediately, but that you understand it's coming eventually, and that you prepare accordingly. Because preparation, discipline, and patience, those three things are the foundation of wealth. They're boring, they're not exciting, but they work. So what happens now? You could close this video and forget everything I said. Most people will. They'll think, that was interesting, but nothing's changed in my life, so I'm not gonna change anything. and they'll be the people who panic in the crash. They'll be the people who lose the most money. They'll be the people sitting out the recovery. Or you could think about what you actually do with this information. You could pull up your portfolio. You could look at what you're actually holding. You could think about whether it's appropriate for where we are in the cycle. You could consider making changes if changes are warranted. You could start paying attention to unemployment. You could start noticing consumer confidence. You could become one of the people who sees the pattern instead of being blindsided by it. The choice is yours, but the pattern doesn't care about your choice. The pattern will keep repeating. October 28 will probably be a peak again someday. Crashes will happen every 8 to 10 years. Fortunes will be made and lost based on who understands the cycle and who doesn't. Be someone who understands it. Be someone who prepares for it. Be someone who positions properly, and when the cycle turns, be someone who profits from it instead of suffering from it. That's the game. That's always been the game. The only thing that changes is the names of the companies and the headlines. The psychology, the cycle, the pattern, that stays the same. So subscribe if you want to keep watching videos about markets and economics and the psychology of money. Drop a comment telling me what you think. Are we actually heading for a crash? Are these warning signals real? Are you going to make changes to your portfolio? I read the comments. I want to know what you're thinking. And hey, if this video helped you understand something about markets or cycles or how to position yourself, share it with someone who needs to hear it. Someone who's all in on stocks and doesn't understand the cycle. Someone who needs the perspective that crashes are normal and they should be prepared for them. That's all I have for you today. Thanks for watching. I'll see you in the next one.